and welcome to this video. Here we will be talking about how to prepare a cash budget. This is the third video in a series. We started with how to prepare an operating budget. That was the first video. The second video is how to prepare a budgeted income statement. And this one is how to prepare a cash budget. So they're all related and they're all using the same basic information regarding the scenario. Now in this one, if you look back at video number 1 or video number 2, you will see all of the information about the sales price and the budgeted sales units and all that sort of stuff. But in this one, we're also got some other information regarding how much cash we have on hand, how much of our sales are actually collected in cash in the month of the sale as opposed to months following. And also we have information regarding our purchases of raw materials and whether or not we pay all of that in cash in a particular month or not. We also have some data about raw material that was purchased in March, because that's important to know. We also have some depreciation that we need to account for. And also in April, the company is planning on purchasing some new equipment. So please remember, and I have the note down there to remind you also, that this video is related to the first video on how to prepare an operating budget, the second video on preparing a budgeted income statement, and so now we're going to look at cash. Cash being generated and collected, and cash being paid out and used so that we can prepare that cash budget. So in this scenario, we have budgeted sales revenue. Now, you may have to look back at that video on how to prepare an operating budget, because we take the sales unit, the expected sales units times the sales price. I don't have that information here, but if you look back on that video, you'll see it. And so basically for April, we had 300 expected sales times $30 a unit is $9,000 in sales revenue. For that sales dollar amount, we collect some of that in cash in the month of April. 90% of it we will be collecting in the month of April. So 90% times 9,000 is $8,100. Now the difference between the $9,000 and the $8,100 is $900 of credit sales, which represents 10% of our sales revenue. Of that $900, we will collect 60% of it in the month of April. So 60% times 900 is $540. The $360, that represents credit card sales from the month of March that are collected in April, which is 40% of the March credit sales. So 40% times 900 is 360. So the total budgeted cash receipts, the actual cash that we will receive in April, is $8,100 plus $540 plus $360. So we'll actually collect $9,000 in the month of April. In May, you go through a similar process of calculating what cash you're actually going to collect and do the same for June. Now what we want to do is compute the budgeted cash payments, the money going out. And this also is using a budgeted cost of purchasing those raw materials, and you will have to look back on that video, the first video on calculating the operating budget, in order to find where I'm pulling those numbers from. The $1,560, the $1,800, and $1,800, I'm pulling those for the different months from calculations that were done in that video. So it's very dependent. If you find this video first, you actually have to go look at that operating budget one to see where I'm pulling those dollars from. Now, of the $1,560 that is paid for the raw materials in the month of April, we pay for 90% of that in the month that we purchase it. So paid in the current month, we're paying $1,404 in cash. So 1,560 times 90% is $1,404. Now, we have some information given to us that the raw materials that were purchased in March were $3,000. So 3,000 times 10% is $300. So we're now paying that part in April. The direct labor, manufacturing overhead, those two lines are coming from that first video where I walked through the math and the logic of calculating an operating budget. So manufacturing overhead and the direct labor, you will have to look there on where those calculations, on how those calculations are working. Then we have to take out depreciation. Depreciation is not actually a cash expense. It is something that we expense, as far as like putting it on the income statement, but we actually have to ignore it for purposes of this because it's not an actual cash item. We're not paying a vendor for it. We're not actually writing a check for it. So what we need to do with that depreciation is actually subtract it out of what we're actually paying, because we're really not paying that to anybody. And then our selling and admin expense, that has also been calculated in the previous video where I walked through the math of how to do an operating budget. So please look there for how to do that part. Then we also have a purchase of equipment that is happening in the month of April. So the total budgeted cash payments for the month of April would include the $1,404, $300, $2,625 of direct labor, $807 of manufacturing overhead, minus the depreciation, plus the selling and admin costs, plus the purchase of equipment. So that equals $9,822. And then you walk through pretty much the same way through each month to come up with your total cash payments. And then finally, we will actually prepare our cash budget. Now assume that the company can borrow in increments of $1,000 and they want to maintain a $10,000 minimum cash balance. So our beginning cash has been given to us. It was told to us in the scenario. We have $11,000 on hand beginning April 1st. So that's our beginning cash balance. We're planning in April to receive cash of $9,000. We're planning on paying out cash of $9,822, which gives us a preliminary cash balance. We then compare that $10,178 to the $10,000 minimum cash balance we want to maintain. So since we have at least $10,000 there, we're not going to borrow any money from the bank. So our ending cash balance is actually $10,178. So let's say that our preliminary cash balance ended up being $8,000. Then we would need to borrow $2,000 from the bank. And so you would enter $2,000 there on cash having been borrowed. And then you just move that ending cash balance to the beginning cash balance of the next month and go through the same thing. Just plug in the numbers. So that is how you calculate a cash budget. Please remember that this video, there's a lot of information left out here because we did a lot of the calculations in that first video where we calculated an operating budget. So please look back at that one. If you have any questions at all, please leave them below. I'll be happy to help you out, and I will see you soon on another video.